Today, we are going to be talking about cost segregation to pay little to no taxes on real estate investments. And, the cost segregation is something that we have talked about. And I just got really excited because I started hearing a lot more people using it and then telling me how much taxes they have saved. So today, I'm so excited to have Geraldine to be here and share with you what cost segregation can do for you. And also she has little tips about why you should be buying properties in 2022, because you definitely want to take some tax advantage that can only apply to properties that you're buying this year. She actually sent me this email when I asked about cost segregation for our investment property. And when I saw this number, I was like, wow, I cannot believe this is what she's going to help me save. So I want to introduce you guys to Geraldine Serrano. Not only she's helping me, but she also has helped a few of our clients before to help them save taxes, really using her expertise to really use cost segregation and then plan ahead how you can save money on going forward. So I don't want to delay any further. I'm going to go ahead and stop sharing and then invite Geraldine to, share some of her information with us. Hi, Geraldine.
Hi, Helen. Thank you for having me today.
Yes.
Hi, everyone. I want to I hope that the information I provide today you find valuable. My name is Geraldine Serrano. I'm a specialty tax consultant with Veritax Advisors. Today, we're going to learn about cost segregation and how you can significantly reduce your tax liability, if not eliminate it for the upcoming tax year. And by doing that, you're also increasing your cash flow. Now, why would you want to do a cost segregation study? So if you are a residential or commercial real estate investor, or even a tenant where you own the tenant improvements, you have taxable income, or you've purchased, constructed, or renovated, including tenant improvements at commercial rental real estate property in the past 20 years. Depending if your costs are $250,000 or greater, then you might want to look into doing cost segregation. Now, what exactly is a cost segregation study? It's a detailed engineering analysis of all the construction and purchasing costs associated with a property. What it does is it separates the real property from the personal property. So examples of personal property are things like cabinets, flooring, security systems, certain portions of the electrical and the plumbing. And outside the building, you're going to have certain land improvements like asphalt, landscaping, wheel stops, bollards that could be depreciated faster. So how does separating the real property from the personal property reduce your tax liability and increase your cash flow? So it's all done through the magic of depreciation expense, which is a non-cash tax deduction taken on all real and personal property. So the depreciation expense reduces the net income from the property, thereby reducing the taxable income and reducing the tax payable for the real estate investor. So this way, the real estate investor gets to keep more cash in their pocket and pay less tax on the rental income. Now, how does this tax strategy work? So let's say Helen bought an office building in Dallas on January 1st of 2019 for $3 million. If she doesn't do a cost segregation study, then she's looking at a first year depreciation of expense of about $60,000. However, she does cost segregation, then she's looking at a first year depreciation expense of over $1.2 million. Now, that's a difference of over $1.1 million. I'm going to go over another example. So now let's say Helen bought an office building on December 31st, 2015 for $2 million. Without doing cost segregation, she would have a cumulative depreciation expense of about $240,000. But if she does cost segregation, then she's looking at a cumulative depreciation expense of almost $600,000. So that's a difference of almost $350,000 spread over the first 5 years. Now, what's the difference between those two examples? And the difference is 100% bonus depreciation. So all personal property purchased or constructed after September 27th, 2017 whether it was new or used, became eligible for 100% bonus depreciation. What that means is all personal property identified using a cost segregation study for buildings purchased or constructed after that date are eligible for 100% write-off in the year it was purchased or completed. Before this date, bonus depreciation was available, but only at 50% and only for new assets. So unless you do a cost segregation study to identify the personal property, you cannot take advantage of the bonus depreciation. Therefore, it's essential to do a cost segregation study to take advantage of it. Also, Helen mentioned earlier about if you want to purchase investment properties this year, the best time is to do it now because of this 100% bonus depreciation rule. Once 2023 hits, it's going to go down 20% every year until it gets to zero. So for 2023, it'll go down to 80%. 2024, it'll go down to 60. So if you wanted to take advantage of that 100% bonus depreciation, then the best time to buy real estate is this year. So how is the cost segregation study actually applied? So on this left side, if you don't do a cost segregation study, you take your gross rental income, which is 200,000 in this example, and then you deduct all your expenses, which would be your mortgage, utilities, maintenance, repairs, insurance, and then you're going to get your net income. So in this example, it's 162,500. Then you're going to deduct the depreciation expense, and then you get your net taxable income, and that's what you report on your tax return, and that's what you're taxed on. However, on the right side, you're going to see the numbers if you were to do a cost segregation study. So you see at the bottom that the results from the cost segregation study wiped out that net taxable income that you would get from that property. So that illustrates the benefits of using this cost segregation study. Now, some investors ask, what if they don't use all of the results from the cost segregation study? Well, it's not a use it or lose it situation. So if you don't use all of the results from the study for, let's say, 2021, then it would carry forward and you could use the results in future years. Also, it can be used to offset income from other rental properties in some cases. Also, for designated real estate professionals, this loss can be used to offset your total ordinary income, which could wipe out your taxable income for the entire year, of course, depending on your circumstances. But either way, cost segregation will create increased depreciation expense to lower your taxable income, which in turn increases your cash flow.
I think this is the part where people don't really understand how powerful cost segregation is. Like until they see that, what, you can wipe out on most of my taxes. Yeah, so hopefully some of you will be utilizing this soon.
Well, since you mentioned that, Helen, I'll tell this story. So last year, a real estate investor out of Colorado had his tax return in hand. This was at the end of March. And an investor told him about cost segregation and told him to call me, because if he were to file that tax return, it would also be with a check to the IRS for over 100,000. And so he called me and said, Geraldine, I want you to take a look at my real estate portfolio. Long story short, we did the cost segregation study on his whole portfolio, and he didn't have to write that. He didn't have to send that check. So it's great to see these real estate investors not have to write a check that they don't have to because of doing this cost segregation study.
And I bet a lot of real estate investors, once they do it, they'll be like, God, why didn't I do it earlier?
Yes, I definitely get that reaction. So who benefits from a cost segregation study? Obviously, both residential and commercial real estate investors. And hopefully you recognize who this is. It's a soup Nazi from Steinfeld. So even if you don't own the building, if you're a tenant that owns the improvements, you can benefit from the study. So a perfect example of this would be, I'd give two examples. A restaurateur, they may not own the building, but they definitely own the improvements by building out the bar, the kitchen, etc. Also, another perfect example would be, let's say you have a triple net lease property. Well, the building owner can benefit from the cost segregation study, but also the tenant, which could be Starbucks, Barnes and Nobles, because they own the improvements according to the lease. So residential And commercial real estate investment owners can benefit from the studies, the tenants who own the improvements, also these different entities, LLCs, C Corps, S Corps, partnerships, and sole proprietorships. Now, who wouldn't benefit from a cost segregation study? Hopefully, you remember this old show, The Brady Bunch. So the only building that a cost segregation study cannot be done on is a primary residence. So does anybody recognize this single family home in the Bay Area? So it is Steph Curry's home in Atherton. So it can be, it can be done on a single family home. It can be done on a duplex, a fourplex. Does anybody recognize this building? It's a brand new apartment building in Brooklyn Basin near the Oakland Coliseum. It can also be done on office buildings. This is a picture of the Salesforce Tower. It can be done on hotels, mobile home parks, senior care facilities, storage facilities. And this is actually an office building made out of shipping containers. Some of you might recognize this building, but this developer created over 30 commercial units. And this also on this property is a beer garden and a coffee shop. It can be done on wineries, breweries. So those are all the different types of properties that a cost segregation study can be done on. When would you not want to do a cost segregation study? If you're going to flip that property within a year, you're not going to want to do a cost segregation study, because then you're going to be dealing with something called depreciation recapture, meaning all that simply means is the IRS is going to want the benefit that you took back. So how much does a cost segregation study cost? So with my company, we provide an estimate at no cost, because you're going to want to see two things. You're going to want to see how much does it cost and how much do we think you're going to save in taxes. From there, if the numbers make sense to you to move forward, then you would sign an engagement letter and provide 50% of the fee to get the work started. From there, an on-site inspection would be scheduled, and the report is typically delivered within 30 to 60 business days. So other things to mention about the fee, it's 100% deductible. And also from our experience, the benefit can be 3 up to 25 times the cost of the study. So the value proposition, let's say, for example, is if the study costs $5,000 and you were going to save $100,000 in taxes, right? You wouldn't have to write a check to the IRS. Obviously, it's a no-brainer to go forward to do the study. So what if the property is located out of California? Well, my company is nationwide, so it doesn't matter where the property is located. So it doesn't matter where your investment property is. Now, are all cost segregation studies the same? So are they identical or are they not identical? The answer is not all cost segregation studies are the same. So when I gave a presentation to this group before, there was a client of Helen's that we actually did cost segregation studies for her on a number of her properties. When we looked at one of the studies that were done on one of her properties, we actually found that the firm that she used produced very low results. And when my team reviewed the report, they actually missed a significant percentage of assets that could have been depreciated faster. So typically when you do a cost segregation study, you're able to move 20 to 40% of the building basis. On this one report for Helen's clients, they only moved 13%. And after my team reviewed it, she could have easily gotten 33%. The other difference is there are firms out there that never take a look at the property. So I had a client who was using someone out of Washington, and he called, and when I gave a bid, he didn't go with me because he had been using this guy for a number of years, which is fine. But a couple of weeks later, he called me and asked me if I thought my team could get the results that were shown on our estimate? And I said, absolutely. So he actually paid twice for this cost segregation study. And when I delivered the report from my team and it matched the results on our estimate, he asked me what was the difference between the report this guy did and the report we did for him. The biggest difference was the guy in Washington that he was using never saw the property. He had no idea what was there at the property. So how is a cost segregation study conducted? So we gather, besides the inspection, we gather as much information as we can. We'll ask for construction drawings, closing statements, appraisals, building plans, to make sure that the study we produce is accurate. So we, like I said earlier, we definitely do an on-site inspection to verify the information that is provided to us. And when we go out to the property, we're going to take pictures, notes, and measurements. Then, after we gather that information, we use a specialized engineering software that will calculate the measurements and count all of the building components that will be shown in our report. So, and it's downloaded into proprietary software that's used for pricing and assigning of the appropriate depreciation schedules. So, and it's completed through a thorough review and documentation of the tax law. So the study is actually done by a construction engineer and a CPA. So we also work with the CPA to make sure our numbers match the basis that the client and the CPA want to use for the building and to the land. So how long does it take to do a cost segregation study? Like I mentioned earlier, it's typically anywhere from 30 to 60 business days. And a lot of people are concerned about what if they get audited? Well, all of our work comes at no additional cost with what we call an audit defense. So if you're ever audited, we will be the ones to defend our report to the IRS agent and help your CPA. So there shouldn't be any concern about that. So can you do a cost segregation study with a 1031 exchange? Absolutely. To maximize the tax benefits you would receive, you would want to do a study on the relinquished property and a study on the new property. Because if you don't do a study on the relinquished property, on the new property, we would not be looking at the basis that we would normally look at, which would be taken from the purchase price. We would have to look at the carry forward basis that would be calculated between the basis from the relinquished and the new property. So if anybody recognizes the scene, this is when Darth Vader dies. So also when, let's say a parent passes away, there's a step up in basis to the heirs. So even if the deceased did cost segregation on the real estate, the depreciation clock restarts when there's a step up in basis. So the heirs can do a cost segregation studies once that step up in basis happens.
Wow.
So a lot of, I know Helen is involved with a lot of multifamily transactions. So a lot of times when real estate investors buy multifamily properties, they're going to do renovation, right? Because they want to increase the rents. So in that scenario, I would recommend a two-part cost segregation study. On the first part of the study would capture the accelerated depreciation on the building as is. And then the second part of the study would capture the accelerated depreciation on the improvements. The first part of the study would also help with what's called partial asset dispositions. The IRS says that you can write off the remaining basis of the disposed assets. So if you want to take advantage and maximize the results you would get with a cost segregation study, I would recommend doing a two-part study. So people ask, does my CPA already do this? No. So cost segregation is an engineering study, and CPAs aren't construction engineers. So they may identify visible assets like carpet can be depreciated over 5 years versus 27.5 or 39 years. But if you really want to maximize how much you get from a study, then you definitely want to have an expert that would look at every asset in that building. So would your building depreciate anyways? Absolutely. But so this is a time value of money play. If you would rather take advantage of the accelerated depreciation you can use now, why wouldn't you? So does it matter if the real estate is separate from the operating entity? Usually not. And what that means is I definitely have companies that purchase the building. And so usually what they do is they set up the real estate in an LLC and they rent it to the business. So in those situations, a cost segregation study would still be beneficial. People ask, can I amend my tax return if they're going to do a cost segregation study? We don't recommend amending a tax return. When you do a cost segregation study, the results that you receive are going to produce what we call a catch-up depreciation in the year that you wish to use the study. So if you've owned a property for a number of years and it's been on what's called the straight line depreciation schedule, all that needs to happen when you want to use the cost segregation study is you have to file an IRS form 3115 and 481A calculations need to be done. We need to take into account the depreciation that you've already taken and how much of the accelerated depreciation is left that you can use now. And with my company, we don't charge to help your CPA complete that form or to do those calculations. So other CPAs and third parties will charge over $1,000 to do those two things. So today we learned that cost segregation reduces your tax liability and improves your cash flow. It can also help with other things. It can help you with the tangible property regulations. The study comes up with a replacement cost for the building, so it can also help you with your insurance coverage, but that's a completely different topic. And so this is my QR code. I'll put my information in the chat. I'll put my email address and phone number. So if you want to reach out and you have questions or would like more information or an estimate, please feel free to contact me.
Yeah, I do have a question. Like, I think when people hear about cost segregation and, talking about all these different things that they have to look into in order to come up with a value, they might think that, oh my gosh, this is too much information for me, or it might take too much time out of me to do this kind of work. I mean, can you go into a little bit like how much obligation does a property owner really have when they need to do a cost segregation study?
So in the beginning, all I need, if it's a recent acquisition, meaning let's say this property was purchased in 2021 or in the past month, all I need is a closing statement and that's it. And then I can provide the estimate. And then from there, if they want to move forward, they just sign an engagement letter, provide 50% of the fee, and just let us know who to schedule the site visit with. After that, it's pretty much a waiting game till we deliver the report. So there's not much work is involved on their part. Did that answer your question, Helen?
Yes, I think that's what some people might think, like, oh, it sounds too complicated. I don't know, but it's literally that easy. I mean, so if they have done some kind of capital improvements or some remodeling work in there, and that's when they probably will have to provide you with a list of work that they have done and the value.
Yeah, so particularly with new construction, then we will ask for plans, the construction costs. So there's a little bit more work involved with that type of property.
Mm-hmm. I see. And do you mind to also talk about, I know we said that prime residence doesn't apply. What about second homes?
As long as it's an income producing property, it can be, a cost segregation study can be done on it.
It has to be income producing. So it's not that second home where you go on vacation and go stay. It has to be an income producing property, like a rental property.
Right. It has to be a rental. I have investors that are pretty clever. So for example, I had to go to Hawaii last month because I have a client that closed on a 2-bedroom, 2-bath condo in this new development. And when I was speaking with her, I thought that she would rent it out, and that she wasn't planning to rent it out, and they weren't planning to live in it. They already have a single family home that her and her family live in. And she said the reason why her and her husband bought this condo, it was all about the depreciation that they need. To give you a background on this couple, they have a huge tax liability. They own over 50 properties all over the country, and they both have full-time W-2 jobs, and they have 2 little ones at home. And so they need this, they have this huge tax liability that they were dealing with. So they bought this condo for the depreciation, but specifically for the accelerated depreciation and the bonus depreciation. It had nothing to do with renting out that condo. So their CPA is going to classify it as a commercial condo. It's their office, right? But if they lived in it, or if it was a vacation rental, they would not reap the benefits of the depreciation or specifically the cost segregation study. And because they have this huge tax liability in Honolulu, this developer, Howard Hughes, is building 16 villages in this ward village. They've already put a deposit down on like the 4th or 5th village, but it's all because they want to get that depreciation.
That's amazing. That's amazing. And Vanessa asked, will the benefit be the same if the investment properties are under different LLC?
So so it all depends on your tax situation, right? So a lot of investors set up each property in different LLCs, right? But it still flows back to the investor. So it would still benefit regardless of how many different LLCs you have set up.
Great. And then also, is it only worth doing cost segregation if the property has multiple units that is complicated enough to have a big difference in tax savings?
So let me give you an example. So I got referred to someone that bought a single family home in Calistoga for $934,000. At the time, we estimated for a $5,000 fee, she could save about $100,000 in taxes. When I went to the property, there were so many upgrades and nice finishes. We actually got her over $300,000. So, that's just one property, right? It's not multiple units. So it doesn't have to be a complicated property with a lot of units in order to benefit from the study. I hope that answers that question.
I think so. Yeah, I don't think I might add on, it's like, I don't think it's the number of units that make a difference. However, it's the purchase price of the property, right? We have gone through that ourselves as well. It's like not all properties actually qualify or worth it. Would you like to go over like in what situation it's not worth it to do it?
Sure. So going back to my client, this couple that owns a lot of properties all over the country, their sweet spot when they look at investment properties are typically in the ones, right? They're looking for proper, single family homes that are 100,000 or more. They have picked up properties under 100,000, but their sweet spot is in the ones. So when you purchase property, you're buying two things. You're buying the building and you're buying the land. So land's not depreciable. So all you're left with is the building. So let's say you've purchased a single family home for a little bit over 100,000 and the basis to the building is 80,000, right? So typically with a study, you're going to be able to move 20 to 40% of, that 80,000, right? So it still goes back to that value proposition. Let's say if you paid $2,000 for a cost segregation study and you saved 10,000 or 15,000, which check would you rather write, 2,000 or 10 or 15,000? So but it depends on the perspective of the investor, right? Some might think, that's not a lot, and some might think, oh, that's good enough for me, right? So it just depends on how they view the numbers.
Yeah, and also I remember when we called, and of course I got my husband to talk to you as well, so he can understand what does it mean to do cost segregation. And one of the questions was that, okay, we purchased this property and then we put in all these money. We put in, like let's say you gave an example, like you bought a property for $100,000, but I put in like $200,000 in it to remodel the property because I got such a great deal. Does it mean that you can actually do this cost segregation on the remodeling that costs $200,000?
Oh, absolutely, because the improvements are going to increase the building basis, right? So I believe this is where you were going, or you mentioned earlier. So the higher the building basis, obviously, the more benefit you're going to receive from the study.
Yes. So if you have done the remodeling, actually, it's really worth it to even do the cost segregation on the upgrades that you have done to the property.
Absolutely.
That's awesome. I mean, I feel like this is something that, again, so many people don't understand or really have any idea of how it works, but it's just so nice to know that. It's just so nice to know that it's as easy as just, hey, Geraldine, I would like to do a cost segregation. Can you give me an estimate? I give you a property address and how much it costs, that cost me to buy it. And then you come up with an estimate. And then your firm actually went ahead and scheduled with our property managers to inspect all the units. And just like what you're saying, we were just waiting game right now and just wait for the results.
Right.
Does putting in solar panels count as an upgrade that you can use as part of the CSS, cost segregation?
So that client that I had talked about that called me last year and had his tax return on hand, and he's in Colorado, he does something called house hacking. So what he does is he'll pick up a single family home, he'll do Airbnb with all of the rooms except for one that he'll live in. And once he gets it cash flowing, he'll pick up another property and repeat that process. So anyway, so to answer this question, absolutely, it can be done on a short-term rental. And of course, the same applies that if you do any improvements, then it would all play into the building basis, and it would just be, you would just receive more of a benefit from the study.
And then also, what about Tesla EV charger?
So, that is a good question, because so what we look at, when we separate the personal property from the real property, anything that isn't considered permanently attached to the ground, is going to be considered personal property. So we would definitely take a look at that.
Awesome. Jackie has a question, I think it's very similar to what we have talked about. Jackie, I actually unmuted or allowing you to talk if you want to ask your questions. Would you like to do that?
Hello, can you hear me?
Yes, we can hear you.
Oh yes, yeah. So question is, if I have a property that I will be using for short-term rental, and I put money in, for example, if I buy the house, like 100K in, and then spend like 50K, would that make sense to do a segregation study, cost segregation study?
So we could definitely take a look at what you're putting in. I know you said a new refrigerator, appliances. So we would definitely take a look at what exactly the improvements are, and we can let you know whether or not it'd be worth it to do a study that would also be taking a look at those improvements.
Okay, thank you.
And question, like Jackie mentioned, the $50,000. Jackie, does that include all the furniture and things like that?
Yes, basically it's furniture and also all the rehab stuff, new flooring,
Right.
plumbing, electrical, and then all the way to refrigerator. Yeah, everything that basically is rentable.
So the cost segregation, Geraldine, meaning that in his situation, even the furniture, because he's using that as a short-term rental, can that be part of that cost segregation study?
So the furniture wouldn't be part of the cost segregation study, but the other items that you mentioned, like the flooring, that definitely will be. And earlier when I talked about the two-part study, before you start, removing and throwing out the old items, I would say to do the two-part study where we would come in before you did any of those improvements.
Have you already done it? Oh.
No, I have video though. I have video of what was before.
Well, for the IRS purposes, they definitely want us to take a look at the items before you dispose them. So the stipulations are, in order to take advantage of those partial asset dispositions where you can write off the remaining basis of what you're planning to throw away, we would have to be able to look at those items before you threw them away. Because just let's say when you're selling a used car, it's going to depend on where it's located, the model, the condition that it's in. So that's why it's really important for us to take a look at what's there before you do any renovation.
So in this case, the CSS will not work?
You can do cost segregation regardless if it was done before or after you've done the improvements. Have you done the improvements already?
Well, right now it's still in progress.
In the middle of it.
Yes.
Well, it just depends on where you're at in that rehab.
In Florida.
Oh, no. What I mean by that, like, have you already torn out the carpet?
Yes.
That's what okay.
Yes,
well,
it's almost close to the later stage.
Right, then it won't, you can still do a cost segregation study, it just wouldn't work with doing a two-part study.
Got it, thank you.
Thank you, Jackie. And I remember you used this one example and said like, oh, if you flip your house upside down, whatever, that like everything will fall off, and then whatever's still attached, that's the part that where you can do cost segregation, right?
Right, so I'm glad that you brought that up, Helen. So yeah, what you want to think of is if you were to turn the building upside down, whatever would fall out is what we would take a look at and what would be considered personal property.
Yeah. Oh, and here is another question. If the property is purchased in November 2021 and it wasn't rented out till January 2022, can the cost segregation be applied to tax year 2021?
Good question. The answer is no, it wouldn't be applied to 2021. It would be applied to your 2022 tax return because it's based on the date that that property was placed in service.
Oops. All right. Oh, okay. Got it. Got it. So what you're saying is like it does apply to 2022, but not 2021.
Right. So that date placed in service is a key factor.
Got it. Good. This is a great question. I'm so glad. I'm sure I feel like I had to go over this like a few times before I could really fully understand. So if you guys have any questions, obviously Geraldine had already put in her contact information here in the chat box. Feel free to ask Geraldine. I had her even talking to my husband because I just feel like I cannot explain to my husband thoroughly how this works, and it was just really, really helpful. So I hope this information session was very helpful to all of you. Want to also remind everybody to subscribe to our YouTube channel, and also you can go to our website, and under HG-TV, you will be able to see all these different playlists of the videos, or if you're more of a reader, you can go to our the blog. This is where we actually type up everything that we share with you on this webinar so that you can read instead of watching the video.